Very excited to be able to ask some tough questions to my fellow panelists. They're, of course, good friends. Chaitanya is an old friend, and Aadit is a new friend. We just met 10 minutes ago. But I've been a customer for a long, long time. And this man has done something truly incredible. If I'm going to watch a TV show in the night, I can order something from my bedroom. By the time I reach the TV, the doorbell rings. And he actually knows the location of the dark store versus my community. That's a founder who's immersed in an incredible level of detail in the business. And do you promise to reveal all your secrets as we get into it, Aadit?
No, 100%. And that's what I'm here for. Just a big expose of all our secrets. But yeah.
Brilliant. And Chaitanya, who's also leading a truly remarkable company, gives 100 days mattress trial or your money back if you're not happy, which is like a seriously bold disruption in a fairly old industry. And you would think with that sort of promise that there's no way he's making money, he's probably burning his way to scale, but that's actually an EBITDA positive company as well. So we have two remarkable entrepreneurs from the startup ecosystem, and personally very excited to get to ask them all the questions about how they've got to where they've got to. So let me start with you, Chaitanya. So here's how we're going to do this. I'll tell you the headline topics, and it's up to you how many secrets you choose to reveal. If they don't get into the right level of depth, guys, please save it for the audience questions and ask it as a follow-up question, and we'll see how it goes. Okay? Deal? Awesome. Okay, so let's start easy, just to get you guys warmed up. Chaitanya, can you tell us a little bit about the early days of starting up at WakeFit? How did the journey begin? It's been, what, 7 years now? So tell us a little bit about how you got started and what the early days were like.
We started off as an accident. This is my third startup and my co-founder Ankit's second startup. And we had tried different things in our lives and then failed at them fairly spectacularly. And then we had bumped into each other at a Sequoia-funded startup. And about 6 months into our friendship, we became friends despite the age gap because of our journeys being so similar. 6 months into this thing, he had the idea that, hey, why don't we start again? And by then, we had both saved about 2.5 lakh rupees each. So we said, okay, we'll empty it out once more and try it out. And that's when WakeFit started. When it was very simple. My two previous startups were on consumer internet. So I had learned the ABCs of digital marketing then. His past experience was in chemical engineering and foaming at Bayer Material Sciences. So we just said, okay, you know supply, I know demand. I'll create the website, I'll do digital marketing, you do the production. That's how it started. And our first employee was his cook. WakeFit was happy, but his flatmates weren't too happy at losing a cook. But we hired him as the first employee, and we had to convince him. We took him to the factory in the car, showed that it's a job. We'll give you 2,000 rupees more than what you get, and convinced him to be our first employee. And our first factory was in the 3rd floor. Imagine a mattress factory on the 3rd floor. So every evening we would pulley down the mattress. We created a pulley and pulley down into the FedEx truck that was waiting. From there to today, running a state-of-the-art mattress factory, which is roll-packed and servicing pan-India, almost 19,000 pin codes. That's been a very steady journey. But to answer your specific question about early days, the two things that really changed the nature of the game was that we got into manufacturing. We didn't shy away from that because that opened up margins and innovation. That suddenly we were very much in control as opposed to being a trader, buying from somebody and selling to somebody. It was an accident, but a really, really good one. The second big thing was we were crazy obsessed with customers. And to this day, I am on the WhatsApp group of WakeFit escalations. Every single person who calls me a cheat, fraud, and other worse names, I engage, get their details, solve it. I think that those are the two things that from day one have been around.
Wow, that's quite a story. I used to handle customer experience at Flipkart. And the first thing I discovered when I took over the customer experience role is how angry Indian consumers always are. So all of you are very nice people in the room. I'm sure you're all smiling right now. But when you go into the mode of being an Indian consumer, suddenly you become angry. I don't know why that happens, but it takes a lot of guts to be in the front line of handling customer experience. Chaitanya tells us a little bit about how deeply you care about customer experience. I want to ask one follow-up question and then come to you, Aadit, which is, this was your third startup you mentioned and the second for Ankit, your co-founder. At what stage in the starting up journey did you realize that you have a real business on your hands, or what we call product market fit had happened, it was real, and then you could actually go on to scale the business from there. How did you make that judgment?
We didn't actually. When I was doing my first 2 startups, I'd read every Paul Graham essay. I'd read The Lean Startup by Eric Ries. But when we started this, the only sole metric of product market fit was, can Ankit take his salary? Because he was more recently married than me. About 8 months later, when we could take 2 people's salary, that was the ultimate success. That, okay, from being failed entrepreneurs, 3 startups between us, we could pay 2 salaries. And that's when we said we'll get in, all in.
Interesting early signal of PMF. Can it afford to pay the salary for the married founder? Okay, very practical and down to earth. Chaitanya, thanks for that. Aadit, your own backstory is fascinating. Tell us a little bit about how you got to the point where you started Zepto and what the early days were like.
Yeah, no, it's obviously been a pretty crazy ride, but I started pretty early on in life, obviously even earlier than this point in life. I sort of fell in love with building probably when I was 13, 12 years old.
Which was last year?
Yeah, which was 6-9 months ago, 2-3 quarters ago. But yeah, no, so it was, it was pretty early on. I think my dad was an engineer. He pushed me in that direction. And, started by building desktops and selling them to people. Found that to be exciting. Then, I met my co-founder today, who, ended up becoming, one of the closest friends I've had since childhood. And he was, much more talented than I was. He taught himself how to code when he was 12, 13 years old. And so I felt a little bit inadequate. And I said, okay, I also need to do that, that journey in software. And, just grew up with that mentality to say, how can I just teach myself how to build, more and more interesting things. And it started very basic, basic Chrome extensions, basic mobile applications, basic websites. But eventually sort of ended up germinating into some pretty interesting projects as a kid. But, towards the end of, my teenage years, I was about 17 years old. And, Kevalia and I, we basically said, look, we've spent the past 5-6 years, probably a couple hours a day, just working on crazy, useless stuff. How do we make a career out of this? Because now life is starting to get a little bit serious. And so we figured the best place in the world to go and learn how to actually, do this hobby for a career would be Silicon Valley, right? Because that's what those guys do. And we figured, what's the best excuse to be in Silicon Valley as 2 17-year-old kids? And we said, we'll probably get a visa if we are college students. So we decided to apply, to study in California, and we were lucky enough to get into university there. But as that journey was starting, obviously the pandemic hit, and we found ourselves back in Mumbai, which is where we were originally from. And we started experimenting. I think we went just back to our instincts to say, okay, now we've got a lot of time on our hands. What do we do? Let's see if we can pick something up that's fun. And at that time, we were also just getting, exposed to the same Paul Graham essays that you were reading. And we said, how do we just build something that solves a problem for like 10, 15 people around us? And the interesting thing is being in an apartment alone, 2 teenagers in March 2020 in Bombay. And we were alone because we couldn't stay with our parents or grandparents who are much older. We don't expose them. And, realizing sitting in that community is that everybody around us had this huge problem getting groceries. The first wave, your online options were taking 6, 7, 8 days at that time. It was incredibly disrupted. Your offline options were just not available in many cases. And so, we were speaking to people. It was very clear that that was a pain point. And so Kevalia and I just started. We said, it's such a simple problem. We just need someone to pick up the groceries from point A, give it to point B. And we started a WhatsApp group that just did that. And that was just it. It was like an early project. More and more people just started joining the WhatsApp group. People could send those links. So, they sent it to their friends and people started joining it. It was basically just Kevalia and I delivering. But over time, when it got to the group limit, I think it was like 200 people on the WhatsApp group, Kevalia said we should just build an app and send it to people. It'll be so much easier and we'll have all the pictures. And so he built an app practically overnight, to give him credit. So it was really crappy, shipped something out. But that's how we got started. And so that eventually started scaling. And basically, the North Star for us was just how do you build a better and better experience for the 30, 50, 75 people that use us. because they knew who we were, and they would get angry at us, if there was something wrong.
Your actual neighbors in your own community.
Yeah. They were the angry customers, right? And so we just kept moving in that direction until we found this like deeper product market fit. And we were a little bit more, I would say, transactional about it, because we would actually just look at the retention cohorts. When we got to like 800, 900 customers, we started looking at the retention cohorts. And we eventually got to a point where we started getting consistently, I think, for us, what we were looking at, because it was very short, was like 60% 30-day retention. And so when we felt good about that, we were like, oh, wow, this could be something interesting. And that's how we decided, let's try to scale.
Got it. Very interesting. And the journey seems almost seamless. You were doing something, you found a serious idea, and you kept building from there. So I'm tempted to ask you the question, Aadit, at what point did it get serious? You said, man, we're on to something. We got to make this big. Did such a moment happen, or did it just...
Yeah. No, honestly, I think the frank answer to that was, we were just building Kirana Cart, and we were approached by a serious institutional venture capitalist, which was Nexus, the first VC that we got on board. We're very grateful to have them on board. But they approached us and said, hey, this product it's pretty good. What are you doing about it? And we said, we have no idea. We're just building this product. And so then they came in and said, hey, you could build something really interesting. And we actually got, I think when it just became a fun project to a company was when we realized that there was scope to actually build a sustainable, scalable business from this. And that came from, I would say, a venture capitalist that had seen it before, and we hadn't really seen a real company. So that was the turning point.
That was kind of when you crossed that red line into now it's got real. It's got real. Got it. Okay, I'm looking at both of you. I'm tempted to ask you a question on the spur of the moment. There's obviously an age difference. Chaitanya, you and I are on one side, and I think it's an interesting question to ask and hear a little bit about your reflections on this. Is you started with zero baggage. Frankly, you said, I got to do something. It got real, and suddenly you find yourself building a major business. Would love to hear your reflections on how it's been to start with, frankly, no experience whatsoever, but you're taking a crack at something huge. And the flip side of that question to you, Chaitanya, is you're a third-time founder. You've obviously accumulated some scars on your back and some real experience. And how do you find that serving you well? Would be interesting to hear your reflections on that.
Yeah, no, I think it's a good question. Again, I think what we got lucky, or what we were lucky about, or got lucky on, was the fact that we were able to very early on get surrounded by people that were just, I would say, best-in-class operators. I would give one example. I have a huge amount of respect for Suvir Sujan, who's the managing director of Nexus. He was the founder of, I think, the first internet company, real internet company in India, Bazi.com, way back, right? So he was this elder statesman in the startup ecosystem, and he actually was, pushed us very early on to be thoughtful and structured and data-oriented. And a lot of the cultural values that we hold to this day came from those like late-night brainstorming sessions that we had with Suvir, where he brought, 2-3 decades of experience on the table, and we brought, the fact that we felt like we had a deep understanding of our customer and the excitement to take it forward. So I think what helped us was that I think we combined the best of both worlds, right? The baggage-free world that we were able to come with, but just like the nuance that people with experience were able to give us.
That's a very thoughtful answer. At some level, you brought your advantages, and what you didn't feel you had, you made sure you got it from outside the team.
Yeah, I think making sure we got it, I think gives us a little bit too much credit. I think we got a little bit lucky also. So yeah, but I basically think once that ball started rolling, where we realized that, oh wow, someone like Suvir can add so much value, then we made it a point in our management team, and we did something a little bit unconventional. We hired a very senior management team on day one, right? And then we just started learning from them. Instead of the traditional startup journey, which is you slowly scale, slowly build a management team, when we had conviction that we had product market fit, we just built a team to say, let's start scaling.
Got it. Super interesting. Chaitanya?
I think I came onto the job market in 2001, 2002. So basically, by the time my 2 startups shut down, I had seen 2000.com bust and didn't find a job then. Then 2005-06, I did my MBA, and then I graduated in 5. Just in the market when the Lehman crisis happened in 2008. And then 2015, when I was again back looking for a job.
I can see Aadit thinking about what he was doing in 2001, and the answer is he wasn't born then. So,
When she was just reading, when she just read the introduction for me and said 20 plus years of experience, and I had read that he's about the same age. So 2015, again, I had seen this crazy, when I was looking for a job, and I'd come back to the job market after shutting down my 2 startups. There, it was very, very clear that people were chasing milestones in order to achieve the next round of funding. If you will remember, for 15, 16, it was just crazy. And I was working in a startup at that point in time. Sequoia funded one, and then a lot of other investors came on board. So that was experience number 1. Experience number 2 that really, really starkly stood out for me was that hype cycles. There was first e-commerce, then mobility, then ride-hailing, then delivery, grocery. So every few years, there's a new flavor of the season, but then that goes up and goes down. That's learning number 2. Learning number 3 was from my 2 startups that all the focus group interviews that I used to build the startups were nonsense. What people said in the interviews and focus groups and how they behaved was utterly different.
100%.
So if you look at how we've built WakeFit, these are the 3 learnings. We don't really care about what the hype cycle is. You build for your customer because they're always demanding, always the North Star metric. They know what they want. I know Henry Ford said that if you had asked the customer what he wanted, he would have said a faster horse carriage. But those apply only to really, really big technological leaps. For most incremental innovations and products, customers know deeply what they want. So just listen to them. And not focus group interviews. Listen to their behavior. Number 2, hype cycles come and go, so don't really depend on your investors, macroeconomic environment, nothing. You have to be close to break even or EBITDA positive. There's only 2 ways to build the company. Because you're not in a winner-take-all network effects business. Yeah. There you have to think differently. And the third one that I said was funding. We never chased funding for survival. It has to be first principles thinking and funding only to grow that.
wonderful. Very interesting reflections, Chaitanya. Thank you. I think you've also provided an interesting segue saying if you're building a business, make it real, make it profitable. And I think that introduces a topic that is very much the reality of the ecosystem today, and would love to hear both your reflections on profitable growth used to be an or. Either I can be profitable or I can grow. I can't do both. Now there's no question of separating the two. If you can't grow, fine, you better be profitable. It is almost becoming the tone of the conversation today. So talk to us a little bit about how are you dealing with you've been leading a hypergrowth business now, Aadit. Talk to us a bit about how are you now threading the needle between growing super fast versus building a profitable company?
Yeah, no, and I think he articulated it very thoughtfully. You look at businesses that have to blitz scale, and I'm sure most people have read the book, or it's pretty straightforward. I mean, you've got 2 or 3 different very, very nuanced use cases where it really makes sense to scale very fast and spend a lot of money doing that. One is obviously the network effects one, and the second one is, what Reid Hoffman calls a Glengarry market, right? Where it's, first place, Cadillac, second place, steak knives, third place, you're fired, right? In those very tough, intense markets. And if you don't scale enough, you start getting wiped out very quickly. And I feel like we were in the latter category, which is why we took the call. That being said, what Chaitanya said is absolutely right. When I look at it first principles, if I was an investor and I had to invest in a company, there are 2 things that I would index on. What are the ultimate output metrics? For me, that's a proxy to shareholder value, right? One is the ROIC that I'm generating. It's as simple as that, right? Car, Henry Ford, you give that example, right? Like vehicle or manufacturing companies, they are very heavy on capital investment on day one. If they're not returning that capital, even if they're EBITDA positive, right, doesn't really matter. So that one ultimate metric, output metric that cleans everything out, right? Over the long term, is this company a valuable company or not? In my mind, A is ROIC. And I think, frankly speaking, 80 to 90% of consumer internet companies in the country will never see meaningful ROIC. I mean, like the companies that have gone public today, I would say 3 out of 4 new age companies will take, probably by the time I'm 50, to return the cumulative losses that they've taken, that they've borne on investors, even assuming they get profitable tomorrow morning, right? And profitable as in PAT profitable, right? Not EBITDA or EBIT. I was reading this, a company that said, we're EBITDA positive. I said, you put 10,000 crores in capex, it's like, it's not difficult to do. But I think but coming back to it, right? So one, I would look at ROIC, and the second thing that I would look at is, is this company, how enduring is this company, right? Obviously, like in the long run. And I think the way that we look at our business today is the only reason why it makes sense to burn any meaningful amount of money is if you're growing incredibly fast. So, today you mentioned like that growth and profitability tension point. I actually think that there are tons of companies today that are still burning money, less money than they were burning a year ago, but are still burning money, but are not growing at all. And that, again, to that ultimate output metric, will kill their ROIC in the long run, right? So the only acceptable reason to burn money is if you're really growing incredibly fast. And so from us, from day one, we said either we're going to be, highly disciplined on our economics, and again, came from a very thoughtful push from people who had seen movies before in the Indian ecosystem, like Suvir and the other investors that we brought on board. We said either we're going to have incredible discipline on our economics on day one, or we're going to be able to grow very fast, and if we need to flip the switch into profitability, we can continue to grow because we'll not be profitable tomorrow morning, right? Because if we stop growing and we're still losing money, even in that interim period, you're really in an unhealthy place, right? And so that's the first thing that I would say. But coming back to our specific use case, I think for a business in grocery, as nuanced and complex and rigorous as you need to be, the beauty about this business, and unlike, I would say, a good chunk of businesses, is that profitability and growth are not just two core objectives that you need to deliver at the same time. They're actually fundamentally intertwined with each other. But if you have best-in-class supply chain excellence, right, not only will you be able to deliver a better customer experience and grow, but you will be able to get better economics. And I'll give you an example, right? Today, you take the pain to build a direct fresh fruits and vegetables supply chain. You tie up with hundreds, if not thousands of farmers across the country. It's painful. It takes time. You need to build software to automate the onboarding process. You need to have, clarity on how you can get the exact pricing to the right customer. The controls you need to build, all of those are very difficult, right? You build that supply chain, it takes a long time. But if you invest in that, best-in-class operating mentality, what you end up having is, you've just got much deeper margins because you are going directly to farmers. Fantastic. You also, because you're able to move the inventory a lot faster, you've got a lot lower wastage, and customers get the fruits and vegetables fresher. And so 80 to 90% of the decisions that I take are one and the same. It's both customer experience and profitability, right? And so today, you guys were giving that comment, right, about the free delivery campaign we're doing. It's exactly the same thing. Today, we spend less than 1% of sales on marketing. Less than 1% of sales on marketing. Almost nothing, which is equivalent to what a Walmart or a Kroger's would spend. We do it because we don't have to charge a delivery fee. We're growing organically, right? So yeah.
All right. And the campaign, I don't know, Rishabh, if you're here somewhere, but Aadit has made sure that everyone arriving into Mumbai to attend this summit could see a Zepto campaign on the way, and it's on the road from the airport. So that's very, very, very well done, Aadit. But on the unit economics and hyperlocal delivery are fundamentally challenging. So how have you dealt with this? Is it that we'll grow less, or is it that we have to build some deep capabilities in the business, like the farming example you gave, that just removes the contradiction between profitability and growth? How have you managed that challenge?
Yeah, and by the way, I appreciate the push to get even more specific, right? So it's helpful. Look, I'll give you a sense on where our economics are, right? Very, very plainly, and the reason why I like talking about numbers is because I feel our numbers are good. So, today we're in a position where, we have these dark stores. They're effectively like supermarkets, but designed for high throughput delivery only operations. So you can compare them to a supermarket chain, for example, right? We are in the process today, this quarter, not next quarter, not 6 months from now, not 12 months from now, this quarter, we have turned hundreds of dark stores fully cash flow positive, fully loaded. Your utilities, your rent, your discounts, your manpower cost, your cost of sourcing, cost of customer support, cost of sourcing the delivery partners, your delivery cost, everything, right? The only thing below that is performance marketing and G&A, right? Corporate G&A. We've turned hundreds of dark stores fully cash flow positive. And the crazy thing is we've done it at an average time frame of 13 to 14 months, right? To compare that to even the most profitable retailers in the world, 7-Eleven, they take 20 months to turn a store profitable. ROIC, right? And to answer your question, how did we do that? What exactly happened, right? Basically in this position where there's no, in this business, and I'm sure it's similar with your business, there are no silver bullets. It's all just basis point by basis point execution across dozens, if not hundreds of line items. So if you have 3 hours, I can go over it. But yeah, no, that's basically what it is. And I think the biggest difference between, and if actually I have to tie it into one thing that's fundamental, if you look at the DNA of our company versus the DNA of most consumer internet companies, most people think this business is like Uber or Zomato or Swiggy.
And that's exactly the perspective I was looking for, Aadit, because it's very easy to create the optics that this business is about growth, just get the customer, we'll figure out the economics later. But both examples you gave of the farming side of the supply chain as well as the delivery side of the supply chain with hundreds of line items of cost control, this is a business of execution and detail orientation.
Correct.
And without that, you're dead in the water.
100%.
So I think it's very nice to look at it from a distance and say, wow, how cool.
Yeah,
but the reality of it is
painful.
Fundamental economic, sound economics, both in the first mile as well as in the last mile.
Yeah, I mean, if you read Sam Walton's biography, right, autobiography, business is about cost management. These kinds of businesses, it's just about cost management and obviously selling more, but both those things are intertwined with each other, right?
Makes sense. Chaitanya, your thoughts on profitable growth?
2015 end is when we started. Till 2018, we didn't raise our Series A. So in those 3 years, I must have met about 42 investors. Sequoia was the 43rd, which said yes. Out of them, one gentleman's meeting clearly stands out for me. We were EBITDA positive, PAT positive, advanced tax paying company. So that gentleman says, why are you paying taxes? Why can't you just go spend that money in advertising and grow faster? In my mind, I thought, I will follow your advice if you cut the check. But finally, he didn't invest in us. So we remained PAT positive, we remained EBITDA positive.
So you know the stories for 43 investors, one by one, you can tell us the stories one by one, Chaitanya. I think investors better watch out. This guy has a long memory, is what I'm taking away.
I remember.
But you said investor 43 said, spend it on advertising and didn't cut you a check. Okay, continue.
So the point is that in the last 6 months, what has happened, that's going to happen once more, because everything, if you take a step back, everything is a pendulum. There's going to be chase growth, chase profitability. Funding boom, funding winter. Just rapid expansion across geographies, no, be close to where your hyperlocal markets are. This will keep swinging, and there's absolutely no way that you can time it right as a founder. So the best way to build the business is to ignore the pendulum completely. So the reason for giving that example of that investor was we will always do the right thing irrespective of what is happening outside. So every line of business today in WakeFit was an experiment once upon a time. We started pillows because there used to be these fabric off-cut layer, strips that used to be left out, which was counting as wastage in our accounting, and we didn't want to throw it away. So we started doing pillows. Even today, if you see the WakeFit pillows, you have a gray strip and a white strip. That's the genesis of that. Once we figured out what fill goes into that, we realized that, the bed sheet that we have been selling, put 2 layers of bed sheet and the same fill inside, it becomes a comforter. Every store that opened, we went to grocery stores and put up our stores there. And they said, no, the throughput is very high and FMCG companies pay us a lot of money. So we said, okay, no problem. Don't give us your shelf space or floor space. Give us your ceiling space. So we started paying 5,000 rupees per ceiling of hyper markets in all the apartment complex areas of Bangalore. And we tried multiple store formats, finally opening up the current format that is having a payback period of 9 months. So every single line of business today, let me repeat, used to be a small experiment with zero funding, somebody's brains being applied there. And with capital coming in, we should never change that. That first principles thinking is what we will always hope to stick to.
Brilliant. I think both your stories, dark stores getting to cash break even in 13 months and stores getting there in 9 months is incredible. And this is not a story of mindless frugality, cut costs no matter what. it is frugality driving extreme innovation in every aspect of how the business is run. So
You're right, because when we get conviction, we're really crazy. We put up a 100 crore furniture factory in 1 year. The first year we did ATL, again we took X210X's help and advice. The first year we did it, we spent about 50 crore. When there's data and when there's conviction, you will not find anybody more aggressive, but not to solve a problem.
absolutely brilliant. Thanks for that reflection on profitability and what the hard work behind it, I think most importantly. You introduced the topic of 43 investor conversations, so I have to jump on that, Chaitanya. You guys are both very, as far as the Economic Times is concerned, you guys are very successful fundraisers. The only story we see is you raised funding yet again, unbelievable valuations, all the good stuff. Now forget all that and tell us what really happens. And tell us what it takes to really fundraise in the way that you want to fundraise. What's the kind of method and process that you have followed?
I maintain an Excel sheet. I note down the name of the investor, the companies that they invest in, the types of companies, what kind of data that they asked, how much of a follow-up that they do after each kind of data drip that I give. Really interested investors come back with follow-up questions. People who are not interested don't come back with reflections, they'll just keep asking for more data. Then who are the competitors that they have invested in? What kind of businesses do they look at? And what is the ref checks that I can get from my founder community? These are things that I keep track like crazily, obsessively. Today, after Series D, that number has gone to 156, 157 investors. And Series A, B, C, I did it on my own because of two reasons. Getting an investor onto your board is almost like getting married. So you better think thoughtfully. And number two, when somebody says no, you better know why they're saying no. Because sometimes it's meaningful, many times it's meaningless, but it's still worth knowing. But when you have a banker, you don't know that. You just get to know that, they said no.
And are you able to get good answers to why they're saying no, Chaitanya? Because oftentimes you don't get a clear signal, right?
You don't get the right words, but you get clear signals.
Get some signal.
Very, very clearly. And that really helps you. And later on, you can always hire a banker. But to know why they're saying yes or a no, and to get the right partners on board after multiple interactions is really, really helpful to actually know them.
I think there's a clear pattern of your personality emerging, Chaitanya. Customer escalations, you put yourself in the coalface. Investor conversations, you're putting yourself in the trenches because that's where the learning's at. Very interesting. Thank you. Aadit?
Yeah, no, I think I, again, very much agree with Chaitanya. I think companies, management teams and founders are, at least at the growth or at the Series A to Series C stage, very structured maturity, they're almost always a function of the quality of the questions that investors are asking them. So if you've got a board that's asking you low quality questions, you will optimize on low quality metrics in the long run, right? And we learned that, I think we got lucky with the quality of investors that we got on board, because you won't find, the larger, more, I would say, liberal, hedge funds or sort of the heavier investors that are on our cap table. You'll find a little bit more thoughtful growth equity, people that are a little bit more low-key, that have invested in deep value businesses, have come with decades of experience of investing, in tech, outside tech, and understand what, building up, frankly, we talk to tech investors, but I think the both of us, we're not tech businesses, right? You're building mattresses, I'm a banya, right? So we're all, we're tech first operational businesses. And so having people that ask really thoughtful questions, push you on important metrics, especially over a 15, 25-year journey of building a company, is highly consequential. And I think right now, over the course of the past three fundraisers, we probably didn't optimize on that quality as much, maybe in the first or second fundraise. But as we got clearer that this is really what's going to drive the long-term value of the company, when that's really what matters. It doesn't matter what valuation it is, today, tomorrow. What really matters at the end is what the score is, when you hopefully go public, right? And so, for us, we said, okay, the much bigger determinant of the long-term value that this company can create is the quality of investors we have on board, not even the quantity of capital that we have. And for us, now that's what we started indexing on. Because I think we're in this position where we're starting to get to milestones on profitability where it's no longer, you get to the beauty about being efficient is that if you're burning like we are, you burn a lot less than the other peers in the industry, and you're no longer dependent on capital to sustain the business. I mean, today we're default alive, right? Which in Paul Graham's terms basically means that within the existing capital we have, we can comfortably get to cash flow positive, right? Without even drinking our own Kool-Aid, we're capable of doing that. When you're in that position where you've got very long runway, where you're still growing the business, and you have the ability where you're no longer dependent on the kindness of strangers, you then have the luxury of saying, okay, who are the guys that I want around the table, right? And that's sort of the big step here. And to answer your question on how it is to actually fundraise, I think counterintuitively, 50% of that work is picking the right people to talk to and invest time with, right? If you go, usually, especially in markets like these, investment decisions are taken in a lot of depth before they're taken at a high level. So if you build the right depth, you can only build with a small amount of investors. So if you pick them well, you build the right depth, that'll be 50% plus of the problem statement of getting over the line or not getting over the line.
Makes sense. It sounds like picking well and the 156-row Excel sheet is sort of the dynamite combination. I don't know if you're willing to offer that Excel sheet at a price in the open market, Chaitanya. I can see that our time's up. I want to ask one more rapid-fire question, literally one-line response, guys, if you can manage it, and then we'll throw it open for a couple of quick questions, is failures. Now, as you look back, like what are the one or two failures that you can learn, and that's most valuable for other founders to learn from? What are the one or two things you would look back and say, hey, we didn't get that right, and now as you're running the business, you're reflecting that wisdom into your management approach. So any one or two failures that stand out, quick headline answers, please.
Taking on too many things and thinking that what worked in one category will work somewhere else blindly, that's completely wrong.
Very
you have
nice.
to discover answers from scratch again.
Yeah, for us, I think it would be, I would say, some of the softer things. When you're building a company very quickly, and you want to have best-in-class performance on bottom line and top line, puts a lot of pressure on people, and being more empathetic of that earlier on would have taken us a longer way.
Got it. Thank you so much, Aadit, Chaitanya. Please, a big round of applause to our panelists for a fascinating perspective. Time permitting, we can take a couple of quick questions from the audience. Are there mics to go around? When you're asking, if you can please introduce yourself very quickly and then ask your question.
Hi, my name is Vipul. I'm the founder of Happy-So, it's a home care brand. My question is for both panelists. So, Zepto started on the, when the COVID hit, and that's the reason your business started. And now, the offline is in its place, and even Wakefit. I know that you are also opening a lot of offline stores. So what is your strategy going forward? And do you think offline will be a far bigger business from your D2C? Or you think, what kind of mix of business do you expect in the future?
I think we're always going to be an online business. And the reason why the online business is so compelling is that in India, who you're really competing with if you want to get grocery spend is the local mom and pop shop. Right? And those people have got incredible proximity to customers. The local Ramu is 300 meters down the road. The local Sabjiwala shows up in the morning right outside your house. The local Doodhwala delivers to your doorstep, right? Those are the guys that we're competing with. Proximity is intense. Now no other, by the way, commerce player in the country has been able to compete with that, which is why even most modern traders haven't had a tremendous amount of success, right? With one or two exceptions like a D-Mart. And when we look at that, I mean, basically we're saying that the only model that puts you in a position where you can be in everybody's homes with as deep proximity to what they're used to in the offline world is the model that we're building today. The alternative would be building a huge amount of footprint that would be fairly unsustainable. And so when we look at that fundamental balance, right, it's something that we think is probably the biggest engine of both growth and profitability of the business is having that proximity. And today, because you have access to so many customers with one store, and you're able to do it with phenomenal proximity, which is only possible with an online model, you get to a point where your throughput becomes so high that for us, rent as a percentage of sales is 90 basis points, right? And that's only possible with a model like ours. So I think, plain and simple, we're going to be an online first business from today to, the day we go public.
In common industry parlance, D2C means sales that happen through your own website. But for us, D2C is a way of life, which means whether you're on Amazon, Flipkart, your own store, franchise, multi-brand outlet, international, D2C means listening to consumers, taking their feedback and correcting it, and building products for what they are looking for. So as long as these are all met, and as long as the unit economics works, we will get into any channel that is legal. It's as simple as that.
Hi, my name is Archit Agrawal. I have a question specific for Aadit. It's not a technical question, but I'm really curious to know, Aadit, what do you generally, so I'm assuming all of us know how demanding your role is at the pace at which you are scaling. You have to manage a big team, investors, and consumer-centric. What do you really do to keep yourself at your best? Because as founders, we have good days, bad days. We are excited a minute, and next minute we are also questioning a lot of things. So as a young founder, what do you do to have that balance and keep yourself extremely happy and balance that motivation, whether it's like meditation or you play, or just curious to know?
So thanks for that. So it really helps if you love what you do. And I really love what I do. I probably maybe even a little bit unhealthy, but I just don't stop thinking about what I do. All waking hours of the day in some format or the other, not because I have to, because I'm worried ABC. Even when the business is going really well, I never feel like, oh, we finally hit this milestone, I can take it easy. It's like, let's do more, because it's such an exciting business. I think the beauty about this is you're operating in a world where most people think it's a crazy business model. Most people don't have the nuance on what's exactly going on. And you sort of feel like you're in this 1999, 2001 Amazon type of situation where you can build a business that frankly is, I believe, can be much, much, much bigger than what most people think it can be, like Amazon 25 years ago, and can be a lot more profitable than people think it can be, like Amazon 25 years ago. And when you're sitting in that position, you feel like very few people have the opportunity in their lives to build a true generational company. And you just don't want to blow it at all. Like, you just need to make sure that you don't want to be the guy that had the opportunity to build a generational company, and then because you got tired, you said, we can't get it done. So that's like 90% of the answer, right? Which is, you're just so excited, and it's probably not a good thing. Maybe it's the benefit of youth, right? But that's one. But I think other than that, it really helps to just have a co-founder that viscerally understands exactly what you're going through, right? Same background, we've been childhood friends. He's my age, probably the only other person in the world that understands what it's like to be in a position where suddenly you're managing people that are 2 times your age, and you've got hundreds of people that are supposed to be reporting into you. And so that is a good balance, and that I think is the core of the company also, that friendship and trust that I have with my co-founder, and so that keeps you sane on the worst days.
If you're going to ask questions saying you're so young and not ask Chaitanya the question, your name is going to go on his Excel sheet. Huh? So you've got to be careful. Any other questions? Now he's saying he meant the question was for you also. You're so young. What do you do?
Good question.
Hi, I have a question.
One second, still answering the previous one. Hang on.
No, I'll be very quick. 2 things work for me. Number 1 is writing, and very old-fashioned writing, fountain pen and paper. The mind races, but your hand can only go so fast. So you're forced to channel your thoughts into a neat, streamlined set of thoughts, and that really brings a lot of clarity. And number two, even I love what I do, similar to Aadit, but I consciously want to switch off, because there are days that I don't want to do one more email, or I don't want to listen to one more customer's complaint. So the way to do this for me is to read extensively. And I don't mean the 52 books in a year kind of extensive, but reflect on every book that I pick. Read very deeply. Read even 3 pages, but very, very carefully. I think reading again enables me to completely block it off and compartmentalize myself. I read this long quote when I was a kid that Napoleon could sleep in the battlefield also. That he could compartmentalize his mind so brilliantly. So that's something to aspire to.
Thanks.
Yes. Hi, my name is Anshul, and my question is for Aadit. This morning we had a session by Mr. Hari Menon from Big Basket. He mentioned that the 10-minute slot delivery in terms of unit economics just doesn't make sense. Wherein we've always seen Zepto's positioning being about 10-minute delivery versus a 40-minute delivery slot, and customers not needing 10-minute can also wait for 45 minutes. How do you sort of handle that in terms of unit economics, 10 minutes, 30, 45 minutes? How do you take that?
Saikiran, do I have your permission to be vindictive? A little bit, yeah. No, I'm just joking. Kind of. But, yeah, no,
I'm just joking, but not really.
So I'll use the term legacy online players. I think situation is, really, I'm going back to ROIC, right? And I really look at businesses that have succeeded. They've generated returns on capital that was invested. It's as simple as that. And until a company has done that, I don't think there's authority to say this is what works, this is what doesn't work. Because when I really take a step back and you look at the online story of grocery in India, started a decade and a half ago. Grocery is bigger than all other categories that Flipkart and Amazon do combined, ×2. And that's grocery. And nobody's been really able to crack it and build real PAT out of it. Right? And sustainable PAT that has equivalent or better economics than offline. And offline, by the way, also, the scaled up retailers, with one exception, really, and even Reliance Fresh has done a reasonable job, but most of them have really not done as well, right? When I look at it right now, and to answer your question, right, couple of things. One, when people ask me, okay, do people really need 10-minute delivery or 30-minute delivery or 45-minute delivery? When we look at the data, the simple answer is we don't really ask that question to ourselves internally anymore, and we try to be as intellectually honest as we can, because we just look at the revenue retention data, and we say that, okay, at a scale of hundreds of thousands of customers that are getting consistent, 8 to 10-minute or 8 to 12-minute delivery versus customers that get 20 to 25-minute delivery, there's a 12-point delta on revenue retention. And this is at a scale of hundreds of thousands of buyers. So when you look at that, we say there's a 12-point revenue retention delta on the table, right? So do customers want 10-minute delivery? Absolutely. If you're giving them 10-minute delivery versus a 30-minute delivery, they'll pick that. But more importantly, when you look at the economics today, and I was telling Saikiran this as well, we have the lowest hyperlocal last mile delivery cost in the world. It's less than 50 cents a delivery, right? Fully loaded. And we're sitting in this position where the reason why we've been able to achieve that is because we didn't take high-level conventional wisdom. We said backtrack, what do customers want? And the customers told us that, hey, if you can give us really fast delivery, fresh products, huge amount of assortment, you can do it with, without a delivery fee, that would be a game changer. We would shift all our spends to that platform, or 70% of our spends to that platform. And when you give them that, and then work backwards, instead of building a supply chain first customer value proposition, you build a customer first customer value proposition and then solve for the supply chain. I think you'll find that you actually end up with not only a better business with better product market fit, but you'll probably end up with a business with significantly better economics today. And right now, I think what we, and I keep telling people this, that today we got hundreds of dark stores cash flow positive, business is growing, we're turning those stores profitable faster than supermarkets turn profitable. So all the data is there. The only problem with the business model is the economic times, the perception, right? Because it's easy to look at something with a 140 character approach and say, this is it, right? This is how it works. Versus you've got what I feel is some of the best supply chain minds in the country that are working to go into a huge amount of depth and solve these problems. Honestly, it's a whole different ballgame altogether. So I think, for us, we're in this position where we just look at the data. We feel good about where the data is. I think we'll find that similar to Amazon in 2001, where they lost, 97% of their share value. I think we'll find there to be very similar dynamics with this business model and how big this business can be, which is why also, some of the most, I think, thoughtful and high-quality investors in the world have invested in our business. I'm sure, by the way, they asked the same question that you asked at some point, and they did a lot of diligence on that. So, yeah.
Thanks. I think we'll leave it there, folks. Hopefully, you guys are around in the break for some follow-up questions. But a huge round of applause for both Aadit and Chaitanya. And I think I've particularly enjoyed the contrasting, almost the yin and yang style. There's no right or wrong, but I think the yin and yang of today's conversation has been absolutely brilliant. So thanks again, Aadit, Chaitanya, and